$1,200. That's how much wealth evaporated from every single ounce of gold in just 48 hours. If you held 10 ounces, $12,000 vanished while you slept. If you held 100 ounces, you just watched $120,000 disappear into thin air. And if you're wondering whether this was just normal market volatility, whether this was simply traders taking profits, or whether this was something far more deliberate, far more calculated, and far more revealing about what's actually happening behind closed doors at the Federal Reserve, you're in exactly the right place. Because what I'm about to show you goes deeper than any mainstream headline will admit. I'm your analytical guide through this financial storm, and over the next 30 minutes, we're going to dissect this crash with surgical precision. We'll examine the exact mechanisms that triggered this sell-off, expose the institutional positioning that amplified it beyond what fundamentals alone would suggest, decode the Federal Reserve signals that most analysts completely missed, and ultimately determine whether this is the beginning of a prolonged gold bear market or a violent shakeout before the next major leg higher. You'll walk away with a complete understanding of what just happened, why it happened now, and most importantly, what intelligent investors should be doing right here, right now in February. Let me set the scene. On February 1st, gold was trading at $5,600 per ounce. Investors were euphoric. Bulls were calling for $6,000, even $6,500 by spring. The narrative was airtight. Inflation concerns, geopolitical uncertainty, central bank buying, dollar weakness, all the ingredients for sustained precious metals strength seemed locked in place. Then, in the span of 2 trading sessions, that entire narrative imploded. By February 3rd, gold had cratered to $4,400. $1,200 per ounce gone. 21% decline in 48 hours. To put that in perspective, that's the kind of move we typically see over 6 months, not 2 days. And here's what should terrify you. This wasn't a gradual slide. This was capitulation. This was forced liquidation. This was a market breaking. Now, before we go further, I need you to understand something critical about how these crashes actually unfold, because the mainstream explanation you're hearing, that this was simply profit-taking or a technical correction, is dangerously incomplete. Markets don't lose 21% in 2 days because some investors decided to take chips off the table. Markets implode like this when 3 things converge simultaneously: a fundamental catalyst that shifts the narrative, a technical breakdown that triggers algorithmic selling, and an institutional positioning imbalance that creates a cascade effect. In this case, we got all 3 at once, and the result was a precious metals massacre that caught nearly every bull completely off guard. So what was the catalyst? Let's start with the Federal Reserve, because this is where the story gets interesting, and it's where most analysts are getting it completely wrong. On January 29th, 3 days before the crash, Federal Reserve Chairman gave a press conference following the FOMC meeting. Now, if you watched the headlines, you saw the usual sanitized summaries. Fed holds rates steady, remains data-dependent, monitoring inflation closely. Standard central bank speak, right? But if you actually parsed the language, if you paid attention to the specific phrasing and the subtle shifts from previous statements, you would have caught something significant. The Fed didn't just hold rates steady, they signaled something far more important. They indicated they are not in any rush to cut rates, and more critically, they suggested that their inflation fight is not over. It simply paused. Here's why that matters. Gold had rallied from $4,200 in November all the way to $5,600 by February on one core assumption: that the Federal Reserve was done hiking, that rate cuts were coming by mid-year, and that real yields, nominal yields minus inflation, would decline, making non-yielding assets like gold more attractive. That entire thesis depended on the Fed pivoting dovish. But in that January 29th press conference, the Fed didn't pivot. They held firm. They essentially told markets, we're not cutting until we're absolutely certain inflation is defeated, and we're not certain yet. That was the crack in the dam. That was the fundamental shift that made the entire bullish gold thesis suddenly fragile. But a fragile thesis alone doesn't create a 48-hour collapse. You need a trigger. You need something that forces immediate action, immediate liquidation. immediate selling regardless of long-term views. And that trigger came from a place most investors weren't watching closely enough: the bond market. On the morning of February 1st, the 10-year Treasury yield, which had been hovering around 4.2%, suddenly spiked. We're talking about a violent 20 basis point move higher in a matter of hours. 10-year yields hit 4.4% by midday, and by the close, they were touching 4.5. Now you might be thinking, 20 basis points, that's not that dramatic. But in the bond market, that kind of intraday move is seismic. And when bond yields spike that aggressively, it sends a clear signal: real yields are rising. And when real yields rise, gold gets destroyed. Let me explain the mechanism, because this is crucial for understanding not just what happened, but what might happen next. Gold doesn't yield anything. You can't collect interest or dividends from a bar of gold sitting in a vault. Its appeal comes from its role as a store of value, a hedge against currency debasement, a safe haven in times of uncertainty. But when real yields, the actual return you get on safe government bonds after accounting for inflation, start rising, suddenly holding gold becomes less attractive. Why own an asset that yields nothing when you can own treasury bonds that yield 4.5% above inflation? That's the trade-off. And when that trade-off shifts dramatically in favor of bonds, gold selling accelerates. And that's exactly what happened on February 1st. But even that doesn't fully explain the violence of this move. To understand why gold didn't just decline but collapsed, we need to talk about leverage and positioning. Because here's what most retail investors don't realize: the gold market isn't dominated by individuals buying physical coins and bars. It's dominated by institutions, hedge funds, and commodity trading advisors who trade gold futures with massive leverage. These players don't own gold. They own contracts representing gold, and they finance those positions with borrowed money. When the market moves against them, they face margin calls. When they face margin calls, they have to sell. And when everyone is trying to sell at the same time, there are no bids. Prices free fall. In the weeks leading up to this crash, speculative positioning in gold futures had reached extreme levels. The Commitment of Traders report, which tracks how different types of traders are positioned, showed that hedge funds and speculators were holding near-record net long positions in gold. Translation: they were all betting the same way, all crowded into the same trade, all convinced gold was going higher. And when everyone is on the same side of the boat, it doesn't take much to capsize it. The bond yield spike was the initial shove. The Fed's hawkish undertone was the fundamental justification. But the speculative positioning was the amplifier that turned a correction into a crash. Here's where it gets even more interesting. As gold started falling on February 1st, breaking below key technical support levels, algorithmic trading systems kicked in. These are computer programs designed to sell automatically when certain price levels are breached. Gold had been holding firm support at $5,400 for weeks. That level represented a psychological and technical floor, the price point below which bulls believed it couldn't go without invalidating the entire uptrend. But once gold broke $5,400, those algorithms started firing. Stop-loss orders were triggered. Institutional risk management systems forced liquidations, and within hours, the selling became self-reinforcing. The more gold fell, the more selling pressure emerged, which caused more declines, which triggered more selling. This is what's known as a cascading liquidation event, and it's brutal to watch if you're on the wrong side. By the end of day one, February 1st, gold had fallen from $5,600 to $5,100, a $500 drop in a single session. Bulls were shaken but not broken. Many viewed it as an overreaction, a buying opportunity, a chance to add to positions at better prices. That optimism lasted exactly one night, because on February 2nd, the selling intensified. Gold opened lower, broke through $50,000, then $4,900, then $4,800. There was no support, no buyers stepping in, no stabilization. By the close of February 2nd, gold was trading at $4,400, $700 more gone in a single day. And just like that, the entire rally from November had been erased, and then some. Gold was now lower than where it had been 3 months earlier, and bulls who had held on, hoping for a bounce, we're staring at devastating losses. Now let's pause and address what I know some of you are thinking. Was this manipulation? Was this a deliberate takedown orchestrated by the Federal Reserve or other powerful entities to suppress gold prices and protect the dollar's dominance? Look, I understand the appeal of that narrative. It's clean, it assigns blame, it explains away losses as the result of external forces beyond your control. But here's the reality. You don't need a conspiracy to explain this crash. The mechanics I just described, hawkish Fed signals, spiking real yields, over-leveraged speculative positioning, algorithmic selling, and technical breakdowns, are more than sufficient to explain what happened. Markets are complex, adaptive systems, and when multiple pressure points converge, they can break violently without anyone pulling strings behind the curtain. That said, there's a deeper truth here that's worth exploring, and it's one that makes some people uncomfortable. Central banks, including the Federal Reserve, absolutely understand how their policy signals affect asset prices. They know that hawkish language strengthens the dollar and pressures gold. They know that rising real yields make precious metals less attractive, and they are not naive about the timing of their statements. So while I don't believe the Fed orchestrated this specific crash in the sense of intentionally trying to destroy gold prices on those exact 2 days, I do believe they were fully aware that their messaging would tighten financial conditions, strengthen the dollar, and put downward pressure on commodities including gold. Is that manipulation, or is that just central banking? I'll let you decide. But what matters for us as investors is not assigning moral judgment to the Fed's actions. What matters is understanding those actions, anticipating their effects, and positioning accordingly. So where does that leave us now, here in early February? With gold sitting at $4,400 and bulls nursing serious wounds? The first question everyone wants answered is simple. Is this crash over, or is there more pain ahead? To answer that, we need to look at 3 key factors: technical levels, fundamental drivers, and sentiment indicators. Let's start with technicals. Gold is now trading well below its 200-day moving average, which currently sits around $4,900. That moving average had provided support for months, and the fact that we're now decisively below it suggests the intermediate-term trend has shifted from bullish to bearish. The next major support level sits down around $4,200, which was the November low. If gold can't stabilize here at $4,400 and instead continues falling, $4,200 becomes the next logical target. And if that breaks, we're looking at a potential retest of the October lows near $4,000. On the fundamental side, the outlook depends entirely on what the Federal Reserve does next and how bond markets respond. If the Fed follows through on its hawkish messaging and keeps rates higher for longer, and if real yields continue rising or even just remain elevated, gold will struggle to mount a sustainable recovery. Remember, gold thrives in environments of negative or very low real yields. It suffers when real yields are positive and rising. Right now, we're in the latter environment, and until that changes, the path of least resistance for gold is probably lower or at minimum sideways in a range. However, if economic data starts weakening, if inflation proves more stubborn than expected and forces the Fed to eventually cut rates despite their current hawkish stance, or if some geopolitical shock emerges that drives safe haven demand, gold could find a bottom here and start rebuilding. Sentiment is the wild card. The gold market right now is gripped by fear. Bullish sentiment has collapsed. Social media is filled with posts from demoralized investors who bought at $5,500 and are now sitting on 20% losses. Coin dealers are reporting that retail buyers have vanished, and some panicked holders are even selling physical gold at discounts just to exit positions. Now here's the paradox. Extreme fear and bearish sentiment can often mark near-term bottoms. When everyone is pessimistic, when selling is exhausted, when weak hands have been flushed out, that's often when assets stop going down. We're not quite there yet. There's still some denial, some hope that this is just a temporary dip. But if sentiment continues deteriorating over the coming days, and we see true capitulation, where even the die-hard bulls throw in the towel, that would be a contrarian buy signal. Let's zoom out for a moment and put this crash in broader historical context because perspective matters. Gold has experienced violent sell-offs before, and understanding how those played out can inform how we think about this one. In 2013, gold crashed from $1,700 down to $1,200 over the course of several months, a 30% decline. That crash was also triggered by rising real yields and a stronger dollar as the Fed began tapering its quantitative easing program. Gold then spent the next 2 years consolidating, chopping sideways in a range, before eventually bottoming in late 2015 and beginning a new bull market. In 2008, during the financial crisis, gold initially fell sharply as investors liquidated everything to raise cash, dropping from over $1,000 down to $700. But that sell-off was short-lived, and gold went on to rally all the way to $1,900 by 2011 as central banks flooded the system with liquidity. The point is this: gold crashes are painful, they're violent, and they can last longer than bulls expect. But they're also not the end of the story. Gold is a cyclical asset driven by macroeconomic forces, and those forces are constantly evolving. What matters is not predicting the exact bottom or trying to catch a falling knife, but understanding the broader environment and adjusting your positioning accordingly. Right now, the environment is hostile for gold. Real yields are rising, the Fed is hawkish, the dollar is strong, and speculative positioning needs more time to unwind. That suggests caution is warranted. But if you're a long-term holder who believes in gold's role as a monetary hedge and a store of value over decades, this crash might ultimately be viewed as noise within a much longer bull market. Now let's talk about what average investors should actually do with this information, because analysis is worthless if it doesn't lead to actionable insights. If you currently hold gold, you have 3 basic options: hold, sell, or add. Holding makes sense if your original thesis hasn't changed, if you're a long-term believer, and if you have the emotional fortitude to withstand further drawdowns without panicking. Remember, the investors who won in gold over the long run were the ones who held through 2013, through 2008, through every crash, because they understood that gold's value isn't measured in weeks or months, but in years and decades. Selling makes sense if your thesis has changed, if you believe real yields will keep rising and the Fed will stay hawkish for much longer than you anticipated, or if you simply can't stomach further losses and need to preserve capital. There's no shame in cutting losses if the facts have changed. The worst thing you can do is hold a losing position out of stubbornness or hope rather than logic. Adding to positions, buying this dip, is the highest risk, highest reward option. It requires conviction that this sell-off is overdone, that 4,400 represents value, and that gold will recover over your investment time horizon. If you're going to add here, do it intelligently. Don't deploy all your capital at once. Use dollar cost averaging. Buy in increments over the coming weeks. Set strict stop losses to protect against further downside, and make sure you're not catching a falling knife with money you can't afford to lose. The worst buyers are the ones who go all in at what they think is the bottom, only to watch prices fall another 10 or 20%, and either panic sell or become forced sellers due to lack of liquidity. For those who don't currently own gold but have been watching from the sidelines, this crash presents an interesting opportunity, but also a trap. The opportunity is obvious. Prices are significantly lower than they were a week ago. If you believe gold has a role in your portfolio as a diversifier, as a hedge against currency risk or systemic instability, you can now acquire that exposure at a steep discount. The trap is equally obvious. Just because something is down doesn't mean it's cheap. Gold could go lower. 4,400 could become 4,200, could become 4,000. If you're thinking about entering a position, be patient. Wait for signs of stabilization. Wait for a few days where gold doesn't make new lows. Wait for some indication that selling pressure is exhausting. Don't try to be a hero and pick the exact bottom. Let the market show you it's ready to turn before committing capital. There's another angle worth discussing, and it's one that doesn't get enough attention in the midst of these crashes: the opportunity cost of holding gold. Even if gold eventually recovers and goes on to new highs, the time spent in drawdown is time your capital isn't growing. If gold takes 6 months or a year to get back to 5,600, that's 6 months or a year where your money is dead, earning nothing, while other assets potentially rally. This is why position sizing matters so much. Gold should be a portion of your portfolio, not your entire portfolio. If you have 10 or 15 or 20% in gold as a strategic hedge, you can weather crashes like this without it destroying your overall wealth. But if you went all in on gold at the highs, you're now facing a catastrophic loss that's going to take a very long time to recover from. And during that recovery period, you're missing opportunities elsewhere. Let's shift gears and talk about the broader implications of this crash beyond just gold itself, because what happened here reveals important truths about the current market environment. First, it confirms that we are in a regime where real yields matter more than almost any other factor. The era of free money, of negative real rates, of central banks suppressing yields and inflating asset prices is over. We're now in a world where the Fed is prioritizing inflation control over market support, where yields can rise sharply, and where risk assets, including gold, can get crushed when that happens. Investors who haven't adjusted their mental models to this new reality are going to keep getting hurt. Second, this crash demonstrates the dangers of crowded trades and excessive leverage. When everyone is positioned the same way, when speculation reaches extremes, the unwind can be brutal. It doesn't matter if your fundamental thesis is right if you're on the wrong side of a margin call. Third, this event highlights the importance of technical discipline. Gold had clear support levels that bulls were relying on. When those levels broke, the trade was invalidated. Yet many investors held on, hoping the levels would hold, hoping for a miracle bounce, hoping that this time would be different. Hope is not a strategy. Technical breakdowns need to be respected. Stop losses exist for a reason. The investors who had predetermined exit points, who sold when 5,400 broke, are now sitting on much smaller losses than those who held all the way down to 4,400. Risk management isn't exciting, but it's what separates long-term winners from permanent losers. And fourth, this crash is a reminder that no asset is safe, no trend is guaranteed, and humility is essential. The bulls calling for $6,000 gold a week ago looked smart. Today they look foolish, but neither assessment is probably true. Markets are humbling by design. They punish certainty and reward adaptability. So what about the longer-term picture? Where is gold headed over the next year, the next 5 years, the next decade? This is where we leave the realm of analysis and enter the realm of scenarios because no one knows the future. But we can construct frameworks based on different macro paths. Scenario 1, the Fed remains hawkish. Inflation gradually declines. Real yields stay elevated, and the dollar remains strong. In this scenario, gold struggles. It probably ranges between 40,000 and 4,800 for an extended period, chopping sideways, frustrating bulls and bears alike. This would mirror the 2013 to 2015 period. Gold wouldn't collapse to zero, but it wouldn't make new highs either. It would be dead money while stocks and bonds potentially perform better. Scenario 2. The Fed cuts rates sooner than expected, either because inflation falls faster than anticipated or because the economy weakens and forces their hand. Real yields decline, the dollar weakens, and gold catches a bid. In this scenario, gold could recover back toward 5,500 to 6,000 by year-end, rewarding patient holders and those who bought the dip. This would be the bullish case that most gold investors are hoping for. Scenario 3, and this is the one that keeps me up at night. Something breaks. The financial system, stressed by high rates after years of easy money, experiences a crisis. A major bank fails. A sovereign debt crisis emerges. Geopolitical tensions explode into conflict, or some other shock hits. In this scenario, gold would initially fall as investors liquidate everything for cash, just like 2008. But then, as central banks respond with aggressive easing and liquidity injections, gold would soar. This is the tail risk scenario where gold ultimately vindicates the die-hard bulls, but only after a terrifying initial drawdown. Which scenario is most likely? I genuinely don't know, and anyone who tells you they know with certainty is either lying or deluded. What I do know is that all three scenarios are plausible, and a prudent investor prepares for multiple outcomes rather than betting everything on one. That means sizing positions appropriately, maintaining liquidity to take advantage of opportunities if they arise, and avoiding the temptation to go all in on any single narrative. It means being intellectually honest about what you don't know, and where the risks lie. And it means accepting that in markets, being right about the long-term direction doesn't help you if you can't survive the short-term volatility to get there. Let's bring this analysis full circle and return to where we started. $1,200 per ounce, lost in 48 hours. That's not just a number. For some investors, that represents their rent, their car payment, their kids' tuition, their retirement security. Market crashes are abstract until they're not, until they're your money, your stress, your sleepless nights. And that's why understanding what happened here, really understanding the mechanics and the drivers and the implications, matters so much, because knowledge is the only edge retail investors have. Institutions have faster computers, better information, more capital, and smarter people. But you have the ability to learn, to adapt, to position yourself intelligently for whatever comes next. You have the ability to avoid the mistakes that others will make, the panic selling at the bottom, the chasing at the top, the over-leveraging, the over-concentration. The gold crash of February 2026 will be studied in textbooks someday as a case study in how markets break when multiple stress points converge. It will be examined as an example of what happens when speculative positioning reaches extremes, when technical support fails, when central bank policy shifts, and when algorithmic trading amplifies human fear. But for you right now, it doesn't need to be a textbook case. It can be a learning experience, a lesson in risk management, a reminder of why diversification matters, why humility matters, why preparation matters. The investors who survive crashes like this aren't the ones who predicted them perfectly. They're the ones who managed risk well enough to still be in the game when the next opportunity arrives. So, as we close out this deep dive, I want to leave you with a few final thoughts. First, don't let this crash shake your long-term conviction about gold, if that conviction is based on sound reasoning. Gold has survived every crisis, every crash, every bear market in human history. It will survive this one too. But also, don't let blind faith override reality. If the facts change, change your mind. Second, use this moment to audit your overall portfolio and risk management. Are you diversified? Do you have stop losses? Are your position sizes appropriate for your risk tolerance? If this crash caused you to lose sleep, you were probably overexposed. Fix that before the next crisis hits. Third, stay humble. Markets will always surprise you. The moment you think you figured it out, they'll teach you otherwise. Respect the market's power to humble even the smartest investors. And finally, remember why you're here. You're not investing in gold or stocks or anything else to get rich overnight. You're investing to build wealth over time, to protect your purchasing power, to provide for your family, to achieve financial independence. That requires patience, discipline, and a long-term perspective. Crashes like this are tests of those qualities. Most people fail the test. They panic, they sell at the bottom, they abandon their strategy exactly when they should be executing it. Don't be most people. Be the investor who learns from this, who adapts, who positions intelligently for whatever comes next. Because there will be a next time. There's always a next time. Markets crash, they recover, they crash again, they recover again. It's the cycle of capital markets, and your job is not to predict every twist and turn, but to build a portfolio and a mindset that can survive and thrive through all of it. If you found this analysis valuable, if it gave you clarity in the midst of chaos, hit that like button and subscribe to this channel. We're here every week breaking down the market moves that matter, cutting through the noise, and giving you the information you need to make smarter investment decisions. Drop a comment below with your thoughts on this gold crash. Are you buying the dip, holding tight, or moving to the sidelines? I want to hear from you, and if there's a topic you want me to cover next, let me know. Until next time, stay sharp, stay disciplined, and I'll see you in the next one.